Over the last 6 to 9 months, small cap investments have generated significant wealth for investors. To understand more about this market segment, we speak with Pawan Bharadia, MD of Equitree Capital Advisors, who follows a pipe approach to managing his investments. Pipe in public, pipe investing is essentially private equity investment to public enterprises. His small PMS has delivered returns upwards of 50% during this time frame. Pawan explains his investment strategy, his aspirations of raising the assets under management, how he is building out the fund, and most importantly, what stands about India in this decade.
A lot of narrative building and a lot of the voices that we're getting from the market really is that India is the best structural growth opportunity in emerging markets, if not the world. And particularly so in the context that China's growth ebbs and investors are looking for alternative growth markets. India has a generational opportunity to become the growth engine of emerging market and international markets. There's also a belief that the GDP can grow above 6% for years to come. Furthermore, the combination of the world's largest general and youth populations, which provides a demographic dividend, coupled with the market friendly and democratically elected government, creates a very powerful backdrop for stock selection and potential outperformance. Some of these factors seem to have already been factored in, just given the numbers and the new highs of Sensex almost every day that we are seeing. I wanted to sort of begin this discussion with you, Pawan. You seem to be in a very sweet spot of the markets per se, a pipe style or a long only hedge fund style of investing where you basically adopt a private equity approach to publicly listed enterprises. As somebody who's covered the private markets for more than a decade, I have seen this happening with the likes of Chris Capital, for instance, which actually was very famous for taking bulk share. And they did something with Infosys, for instance, and it was a page one news story when they did that. Then we also have funds like Nalanda Capital, which really have really built a great track record and a lot of market admiration for themselves by adopting a very secretive style of going and investing into companies. What really is the equity style of investing and investment strategy? I would like to know more about that. Yes, Pawan.
Sure. First of all, thank you very much, Sheja, for having me over. Yes, you are right. What we do is very akin to what a pipe fund is all about. You took certain names, Chris Capital, Nalanda. We're pretty much on the same lines as what a Chris Capital or Nalanda does. Except for the fact that for the sheer size that Nalanda has, they are more focused on doing the strategy on some of the larger small caps or the larger mid caps. Whereas given our AUM, we are more focused on the micro cap space of the listed segment. When we say micro cap, this means companies in the market cap range of 200 crores going up to 5,000 crores. That's the genre in which we look to invest into. Coming from the private equity background, this is a genre where we find very similar characteristics to those of unlisted companies. As a growth capital investor into these kind of companies, I've seen most of these businesses would have at least about 2 decades of more of operating history. So the business has seen enough ups and downs and survived themselves, and usually family run and be at an inflection point for a very, very high growth, so to speak. And this growth could come about either because of operating leverage playing out. Most of the times it is operating leverage playing out, and or sometimes it could be certain regulatory approvals which have been long pending, or maybe at times some vendor approvals which have been long pending coming about and changing the course of the company altogether. So that's the business segment that we look to invest into.
Thanks for that, Pawan, sort of talking about the characteristics of the companies you're looking at. But why micro small cap? Is there a reason that you have selected that? It's just a function of your AUM? Tomorrow, if you raise a larger fund from your LPs, would you sort of go up the investing ladder?
So there are two parts to that. One, of course, we started small, so naturally, this was the genre that best suited our investment strategy. More importantly, all of us know intuitively, and there is enough documentary evidence that this is the genre where largest wealth creation happens, because these are the companies which can grow at 30% plus kind of a CAGR, given their low base for very long periods of time. So, I mean, today when we are investing in companies with top lines of anywhere between 500 crores to maybe a few thousand, we are looking at these businesses growing at 25 to 30% kind of CAGR growth. Now, that kind of growth doesn't generally come about in larger companies. So, I mean, if you look at names like Hero Motocorp, for example, or all of us talk about Titan. So, the kind of growth which Titan saw in their early days is significantly higher, both in terms of their operating profit as well as the wealth creation which Titan did than what it did once it became the large cap.
But
So I
there's
guess it's a
also, but the risk is also higher, right? One can also argue that. I mean, if I were to take a extension of this in comparison to say venture capital, which invests essentially in private listed and private companies, not the listed companies. So you are at the one end of the funnel, basically, where the risk is high return. Basically, that is the game and that is the formula. You're coming into early stage, right? You're coming into the early life cycles of the company. But how is an Equitree different from others? All of you have capital. The color of the money is green. All of you, the sound bites are so similar. Shrija, we adopt a disciplined approach. We have a very research oriented approach. All of you have credible pedigree, 25 years of experience. So, how is it one Equitree is different from the other? What really is different here? And more so when I talk about public investing, because in private markets, one can actually say that Shrija, I bring this experience to the table. It's very specialist experience because you have to work very closely with the promoters and drive that growth. In public market investing, I would like to understand how is it really different one from the other.
So there are too many questions followed up over there. Let me try and answer one by one. One is how do we different from the venture capital, which is doing in the private segment. First of all, we are not taking the early stage business risk. Like I mentioned to you, the companies that we look to invest in, these would have been in existence for at least about 2 decades or more of operating history. So these are businesses which would have been in existence for a fair amount of time. They would have seen various highs and lows during their life cycle already. Extremely profitable companies, extremely cash-rich companies, and that is where we generally don't like to participate in the primary investing into these companies. These would all be businesses which would have very high level of internal cash generation, which would be funding the growth for these companies. So that's the kind of businesses that we like. So we are not taking the early stage business risk. What we are taking is certainly the execution risk of the high growth that we are talking about. And that's the only risk that we take. And that is as much applicable to whether you invest into small cap or a large cap or, any equity investing that you do, you end up taking an execution risk. And that's exactly what we do. Uh, where we start differentiating is, you said that, most of the guys would be having similar kind of disciplined approach and so on and so forth. Yes, but I really haven't come across too many investors who are focused on getting onto the ground with these kind of companies. See, this is a genre which intuitively almost everybody understands that creates largest wealth creation, and everybody would have some of the other micro cap in their portfolio, for one reason or the other. This is also the genre which is known for the largest number of accidents. So while there is one Hero Motocorp or one Titan that everybody talks about, there would be maybe 50 other companies which would have gone down the drain. And that's where it is extremely important to pick up the right businesses which can be scaled up and back the right kind of promoters who have the execution capability. I think that's where we start differentiating, where we, given the private equity approach that we bring in terms of the due diligence and so on and so forth, our ability to identify and differentiate between this business is extremely high. I mean, uh, just to give you a sense, the last 11 years, we've invested in about 41 companies all put together. and our strike rate has been well over 85%. So what that means is, despite the genre in which we are investing, our investment calls have been right more than 85% of the times. And that is something that we're very proud of, the kind of system and processes that we have built around identifying these businesses. That is a huge differentiating factor so far as we are concerned.
But Pawan, everything looks good in a growing market. Everything looks nice in a growing market. And one has seen this, right, over a period of time. And now with the markets reaching new highs every other day, and especially with this very strong narrative of a very strong government coming in at the center, and this is very interesting here. What do you think is a differentiator then? How much of it is? Because I personally see that everybody is making money. I see quant funds also making money. I see index funds also making money. I see AI powered algorithm funds also making money. So, is India really a beta play or an alpha play, which is already being called, where you have to really cherry pick the fund managers, or is just bet on India per se?
So you are right that last 1 year has been very buoyant, and I mean you're talking about funds. Even housewives and panwalas would have actually made a decent amount of money during the last year.
Well, that
But the
happened.
crux,
That's the time to stay away from the markets, by the way.
that's a time to stay away. I would not say that's a time to stay away from the market. That's a time to be a little more watchful and cautious in terms of where you are putting your money to work, right? And that's again where we differentiate in terms of, because we know the businesses that we hold, and for us, the platform of stock market or the stock prices is just providing an exit option to us at any point in time. Uh, we, I mean, to put that in perspective, we've seen the portfolios going down even 50% during COVID times, for example. And we haven't sold a single company during that phase. So the real test actually comes about when the market is in a downturn and the tide is done with. That's when you start realizing that who understands and knows how much of what is being held in the portfolio. Today, the performance that you are seeing on Equitree is largely on the same portfolio that we used to have back in 2017-18. So for us, knowing the business gives us the conviction to hold on even in bad times. When back then, most of the fund managers would have churned their portfolio anywhere from 40% to maybe 60, 70%, depending on where you are. We did not churn anything, practically anything in the portfolio. So yes, when the market is on a roll, creating returns are obviously much more easier. The difference, I think, comes about in even in a good market. So, for example, last year, where the Nifty gave about 26% kind of returns, our returns are actually close to 100%. So that's the alpha generation that you're talking about.
So tell me one thing then, Pawan. Give me a sense of your AUM trajectory. How much do you have under management now, and where do you go from here? And who exactly are your LPs? Do you have domestic investor participation, or are they more institutional in nature?
So we are still very young, Sheja. We, we just crossed 200 crores in AUM a couple of months back. In fact, at Equitree in 2012, we actually started more like a prop investment office. So from 2012 up until 2017, what we were doing was just managing our own capital and just friendly advice to close fraternity and friends on a non-commercial basis. It's only since 2012, 2017 when we took the PMS license. Even when we took the PMS license, we were seeing some froth in the market back then, and we held back the entire fundraising exercise. So we've effectively got into taking third-party capital only in 2020 onwards. And in the last about 4 years, we've got to about 200 crores. That's a number which I told you. Having set up the systems and processes in place in terms of identification of these kind of businesses, which are grossly under-researched and under-invested, and being an early investor in them, we are now looking to scale this up to a fund size of at least about 1,000 crore, where we can buy deep into some of our existing companies and behave more like a private equity fund. So take long-term investment calls with at least about 5 to 6 years kind of a horizon.
So when you compare yourself to a typical private equity fund, I mean, the hurdle rate one usually talks about from their LPs has basically been 8%, and only few of them have been able to over deliver, right? If I were to talk about that compared to your numbers, how would you sort of feature that?
So for the last 4 years, since the time that we started taking third-party capital, our CAGR is at about 41%.
Okay. And give me a sense of your LPs. Who are these people?
So these are essentially ultra HNIs and some family offices. We have a couple of CXO level people also who have invested with us. I have ex-partners of private equity funds who have invested with us. So it's a very intelligent lot of investors. There are a lot of professionals, doctors, lawyers, and so on and so forth. So these are all very learned class of investors who have been in the market, who have been there, seen all kinds of investing and so on and so forth. That's the genre of investors that we represent.
So you also retail. So what's your minimum ticket size like? Is it like a crore?
I mean, my ideal size is 3 crore plus.
Mm-hmm. Okay. But wouldn't you want to be more blue chip now in terms of your investor preference and profile now that you're raising 1,000 crores, right? So just raise it from like four people, right?
Uh, we'll see how it goes. So we're talking to different kinds of people. I mean, this is not a retail product for sure. So we are
Absolutely.
not looking to take that 50 lakh rupee kind of a ticket size. But yes, I mean, we do have a bracket where we take 1 crore to 3 crores as well. But our ideal size is 3 crores and upwards. So yes, we are talking to different kinds of investor class, family offices, HNIs, ultra HNIs, trying to see. I mean, we have investors from offshore as well. So I have investors from Singapore, Hong Kong, Dubai, US, and the likes. So we're talking to different kinds of people, trying to see how best we can get there.
Yeah, because if you really want to emulate a private equity fund, you would want to look at your investment profile, your investor's profile. You would want to get more sophisticated there because the private equity business is for very sophisticated set of LPs or investors.
Yeah.
So I spoke and got to know and got a fair sense of Equitree Capital and where you are in the investment ecosystem. There are quite a few players also as to what you're also doing, and I mean, a lot of them have also recorded good numbers. But I
Sure.
also want to sort of get a sense from you on the market dynamics, for instance. Really, I mean, where are we in the markets? How does one really drive sanity as to what we are seeing right now? Is this the market for salaried professionals like us, or is it the market for really HNIs? I mean, what kind of market is it right now?
So I'd like to slice it down, Sheja. There is a lot of talk of the high valuation, the premium valuations across the market, and so on and so forth. And there
Mm-hmm.
indeed is froth in some parts of the market. But one needs to understand that where exactly this froth lies. I mean, the way we look at this whole thing, the froth is actually largely into two segments. One is particularly on the SME exchange, where all of us have seen the kind of IPO that happened over there and the kind of returns which got created on the SME exchange. That's something which completely something that we can't really relate to. The other piece, which is little premium in terms of the valuation, is the larger small cap. When I say larger small cap, what I mean is companies which are above 5,000 crore market cap, going up to about 20,000 crore upwards, and the mid caps. So companies which are between that 100 to 150 bracket. So if you look at the valuations of these categories, that's where you will find these companies trading at significant premium to their long-term averages. So just to share numbers with you, when we did some bit of analysis, the small cap space, the larger small cap space, is trading at about 27% premium to its valuation. And when I say 27% premium, I'm talking about long-term 10-year average valuations. Likewise, the mid cap space is trading at close to about 31% premium to its long-term 10-year valuations. Our genre of companies, when I talk about, which is the companies in the market cap of 200 crores to going up to 5,000 crore in terms of market cap, they are trading just at about 7% premium to their long-term average.
Okay.
And so we don't see there are enough and more opportunities within this genre where businesses are growing at close to about 25 to 30% kind of CAGR, and the valuations are still close to their 10-year averages. In fact, our own portfolio is trading at just about 16 times on FY25 numbers. So
So tell me
there
one
are
thing.
opportunities.
Yeah. So historically, if you look at from a private equity perspective, I mean, the private market valuations are always at premium to public market valuations. That really has been the game because the private equity investors tend to give that premium. For you, when you talk to these promoters, because you mentioned some of them are first generation family entrepreneurs also, and Shrija, the operating leverage is very high, and they're like 2 decade old. Most of them, you use the word underreported, right? So
Yes,
I
are
want
underinvested.
underinvested, yeah. So I also want to understand from you that when you meet up with these promoters, what is the conversation like? Is it a push or a pull? I mean, what kind of market is it? Is it a buyer's market or a seller's market really right now? Because there's just so much capital available. Do you really have to negotiate very hard on valuations? Are they really, really forthcoming and willing to get an investor on board?
So the good part is that I don't have to sell myself. These are all companies which are listed. So all that we need to do is just do our bit of research and the groundwork and everything else. And these are all listed stocks. These promoters, most of the companies that we have invested in, they haven't raised any equity in the last 5 years that we have been invested in. So there has been no dilution. So I don't have to haggle with them on the valuation front, so to speak. They're all listed. So if we are comfortable with the valuation, I can just go out and buy in the market. These are all relatively liquid stocks, so to speak. So unless if somebody wants to buy 10% or 15% of the company, then yes, you may need, I mean, that kind of liquidity may not be there. But given our size and given our aspirational target where we want to reach, so today we would be holding anywhere between 0.5% to 2% of these companies. Uh, and that is very easily, available in the marketplace. I mean, we don't see any difficulty in accumulating that thing. Even if I were to go to 3 to 5%, which is what our desired target is, stock availability is not so much of an issue. So I do not have to get into the valuation conversation with any of the promoters. If you like the business, we can just go out there and accumulate as much as what we want.
Okay, so it's not necessarily primary because or secondary market sales that you're
Correct.
doing. Tell
Correct.
me a little more. You said about the SME exchange fraud. I mean, we have seen couple of IPOs, for instance, and there's a FOMO building out. Oh, I missed this IPO. I mean, look at the price you could have entered because a lottery system. At least I hear that from a lot of retail investors, and because the listings have been huge premium of late. Do you think it's sustainable? I mean, what really is factoring into this? Because some of the listing pricing doesn't really make sense at all. So, what really do you think is, I mean, some of the IPOs that we have seen of late, uh, the math doesn't really match. So, what really is happening there?
There's an old saying that when something looks too good to be true, it rather may not be.
Yeah.
So, and that's exactly what I said that, on the SME exchange, the way the prices have been and the valuation of some of the companies are completely through the roof. And, we find it extremely difficult to comprehend that why somebody should be paying that kind of prices. So, I mean, we're completely staying away from that.
Yeah, I was talking to you about suppose a company like Zomato, for instance. Right now, it's on the other end of the spectrum in terms of valuations and size. But would you be open to looking at some of those kind of businesses? But because the
Uh,
understanding one gets from the portfolio or stock selection is that it would be more like in the comfort zone, like first generation family entrepreneurs, 2 decades of operating history. But some of these tech businesses, which are VC backed, can also be very, very easily disrupted, right? It's like investing in the unknown. So I want to understand from you.
Unfortunately, we haven't learned the art of investing into these kind of new age businesses, Shreya. Uh, so fundamentally, we are far more comfortable in businesses which are already cash positive and are churning out decent amount of cash, which can fund their expansion plans. We somehow have not been able to come about and look at businesses which are still cash burning. I mean, Zomato has recently turned profitable, but most of these new age businesses are yet to be tested in terms of which one of them eventually survives and so on and so forth. So we consciously again choose to stay away till I think the environment stabilizes and we have some clear leaders or some basic rules of the businesses of how it is getting played out and so on and so forth. Fundamentally, we are far more comfortable investing into the old economy, manufacturing, uh, engineering, infrastructure, consumer kind of businesses rather
Yeah.
than the new age tech companies.
Yeah, I imagine so. I got that sense from your the initial remarks that very, very focused on cash rich businesses. And that is like the number one sort of stick for you. And companies not generating cash could be a huge red flag, no matter how tempting it is.
Yeah.
Great. I also want to understand more from you on the market direction. I mean, 2024 supposedly the historic year, right? I mean, half of the world, more than half of the world is going into polls. It's a very, very interesting dynamic for the global democracy. Where does India really stand in the new world order, so to speak, right? And given these listings of Indian stock markets ahead of Hong Kong, lesser than America, more than China, what do you think will the pecking order or the listing order look like according to you?
So I would not get into India's listing in terms of the global order for the stock exchange numbers. I mean that's just number game. But what we definitely see on the ground when I talk to the promoters of different businesses is something that what India is experiencing at this point in time, or the Indian corporate is experiencing at this point in time in terms of opportunities, is something that I haven't seen in the last 25 years of my investing career. I mean, thanks to China plus one, which got played out, and in fact, India is just scratching the surface even when China plus one is concerned. Uh, Ukraine war has unleashed the whole Europe plus one opportunity as well. And between these two, there indeed seems to be a phenomenal opportunity for the Indian corporate to rise up to the occasion. We have had these kind of false alarms even in the past, but India was not prepared. This time around, again, when we look around and we see the kind of corporates or the businesses that we're talking about, thankfully, right from the GST implementation to demonetization and various other reforms which have happened in the last about 10 years, the way and style of corporate India's functioning itself has undergone significant change. And that is driving uh, this opportunity where a lot of people have risen to the global quality standards and increase their whole quality consciousness, and they're getting paid today for their quality rather than just trying to skip the surface and be happy with that thing. If we are able to rise up to the occasion and deliver the kind of global quality standards that we're talking about, and we are seeing that actually. So if you look at what is happening on the electronics side, for example, from being complete importers, net importers, India is exporting electronics to the whole world today. Likewise, the same thing happened in chemicals and pharma. So it's not too much out of reach that we should see something similar happening on the manufacturing engineering side. And we're already hearing about India exporting defense equipments, for example. We're talking of India exporting missiles to some of the Asian countries. We've never heard these kind of opportunities. So a lot of these kind of opportunities are shaping up. So if you look at from a global manufacturing merchandise perspective, India's contribution has barely been about 2% or thereabouts, which even if we inch up to 4%, that's like a huge 100% kind of a growth that can come about.
So, what really has fundamentally changed? It looks like a investing in a perfect storm kind of environment. It's a perfect storm right now, right? You spoke about the Europe plus one, the China plus one. If one were to give like a slogan to this, investing in India, it's like investing in a perfect storm because India is capitalizing on some of these trends that are happening, but intrinsically about the India opportunity. Like we talk about India as a standalone opportunity. You said that you have not seen this it's a once in a generation opportunity for you because you've not seen this in the past 25 years. So what really has fundamentally changed?
So, like I mentioned to you, the whole quality consciousness has come about. I mean, you see a lot of Indian corporates where earlier they would not be as much quality conscious and focused on doing mass market kind of production and so on and so forth, where they would be playing on very very thin margins. There's a consciousness to grow up the value chain to begin with. Europe plus one is opening opportunities where Indians are actually buying out, companies based in Germany and the whole of Europe and so on and so forth. So suddenly you have a European front end engineering company which is helping you do the marketing for your Indian products, so to speak. Now these kind of things have not been there. I mean, the entrepreneurs have also grown up in their own genre and perspective where they are addressing these kind of opportunities. We're seeing a lot of Indian companies setting up manufacturing shops in US, because as much as what we are talking about, make in India, US is talking about make in US, and Indian companies are realizing that there is an opportunity where you can set up a shop in US, have some bit of manufacturing done over there, send maybe semi knockdown conditions from here, do the last mile assembly in US, and you have a US market completely opening up for you. So the thought process itself is changing. The other important thing is, when you look at the quality of the balance sheets today as compared to what it has been historically, again, I think corporate India is sitting on its lowest leverage at this point in time. So, just to give you another example or some statistics, companies in our portfolio, we are sitting on a debt equity of just about 0.3.
Wow.
Right?
Interesting.
And that's the quality of the balance sheets in general. I mean, today, if you pick up 10 companies which are talking of expansions, maybe 5 of them are largely funding through internal accruals. Bank debt is only about 20-30%. So when you are doing these kind of capacity expansions with your own internal accruals, your ability to withstand volatile environment is significantly higher than when you are taking 80% debt and you get caught onto the wrong cycle, and you may just vanish.
This is a great segue to my next question. I mean, talking about getting caught up in the wrong cycle. I mean, there's always this thing when you talk to experts like yours, and it's been a very interesting conversation so far. Let me tell you, I've really sort of enjoying it. This entire thing of India and this money coming in cycle. I think when the COVID situation happened, it was a very benign kind of interest rate environment. Money was typically like practically available for free, right? I mean, with interest rates were zero. And now some things have changed. I mean, money cannot be free forever. Is this the manufacturing cycle for India as it is being told? So the tech cycle was maybe the 2-3 years back, now is manufacturing cycle. And then this entire sort of narrative building that maybe after 5 years, again, the China cycle will begin because this can't go on forever. So what really is your sense? Give me some clarity there.
So manufacturing is definitely a decadal opportunity. I mean, so that's what we were just talking about, right? Kind of opportunities that people are rising up. Even if we are able to increase India's contribution from 2.4% to let's say 5-6% in the global merchandise trade, I think that itself will be good enough to consume a lot of Indian capacity, so to speak. So this is definitely decadal. Having said that, this is not like as generalist as what one may sound. So it's not like this kind of opportunities are available to everybody in the sector. This opportunity will be available only to the guys who have risen up in value chain in terms of their own quality consciousness and have been able to get a foot in the door in global supply chain of MNCs and so on and so forth. It's only those people who are leveraging this thing. So yes, on one side you have that. On the other side, you of course have the Indian demographics itself, which itself is a massive opportunity in terms of the infrastructure spend and the consumer spend and so on and so forth, which always continues and has been that way for quite some time and will continue for times to come. So between these two, three segments, so to speak, there are enough and more opportunities that one can look for.
Thanks for that, Pawan. Given you are such a close observer of markets, especially in your micro cap space, you got to give me at least three trends that are really, really exploding that you see. It either could be a sector allocation perspective or maybe some companies that you think are really exploding. What would that really be? And then we could, because we're getting towards the end of the conversation now.
So you should look at something what is happening in the textiles. Now, India has been a global leader in terms of home textiles,
Mhm.
and enjoying more than 25% market share on the home textile side. But when you look at apparel, India has not been as much on the apparel scene. In fact, when apparel trade started moving out of China, it first went to the other Asian countries, Bangladesh, Vietnam, Indonesia, so on and so forth, for multiple variety of reasons. One was the biggest of all was labor arbitrage. As compared to India, labor was far more easier and cheaper in these geographies. When imagine that India would export cotton to Bangladesh and then Bangladesh would end up, sending apparel back into India. That was the situation. That's changing now, and that's changing very fast because the labor arbitrage is going out. Second, like I mentioned to you, Indians have been rising up in terms of quality consciousness and so on and so forth. So that is giving a lot of these kind of opportunities. Uh, there are high quality companies which are focused on the apparel segment, looking at both the European as well as American markets. I think if India has a decent chance to gain significant market as compared to their Asian peers, if the FTA, as and when it gets signed with UK, when we had one with the other European nations, but if UK FTA happens, that will again further level India's opportunity vis-a-vis some of these other Asian countries. So that's a segment that one should really watch out for. Uh, I gave you one on the global opportunity. Let me give you another one on the domestic opportunity, so to speak. So within domestic, I mean, we are very focused on, we're very upbeat about the whole agri opportunity in India. So anything which enhances agri productivity by way of mechanization. So one is you could be using fertilizers and chemicals for better productivity and so on and so forth. But mechanization is still grossly underplayed in India. So anything to do with agri productivity on the mechanization side can again be a very, very interesting play to look at, given the kind of Indian demographics that we have and the need for independence on food and agri. Anything which can enhance productivity because of mechanization is likely to do extremely well in times to come.
Pawan, my last question to you, the word of advice or caution. Investment bankers seem to be extremely happy post some of the successful IPOs. So, one word of caution to the bankers, and the second word of caution to the investors who are still on the sidelines and looking at India. What should they be looking at?
So there are going to be opportunities. One needs to be focused more ground up. The macros are looking anyways good. That's what everybody is selling about, right? But it's more about the ground up business opportunity. And what we like to do at Equitree is, focus, be very, very focused on the valuation. So for us, valuations is at the time of buying the asset. So we are more focused on what we are paying when we are buying something today. And that's something which I see a lot of bankers, missing out on that thing because most of them start selling 2 years forward, 3 years forward kind of multiples. And all of us know how dynamic world that we live in. 2 years and 3 years can change the whole business environment. And we've seen that happening enough and more number of times now. So if there is a comfort on the entry valuation, then you will be able to see through the kind of volatility that comes about, and that gives you a lot of conviction and room to hold on to your investments. If you're buying at extremely high valuations or valuations which look reasonable on 2 years and 3 years forward multiples, and if that doesn't come about, the impact can be significantly high.
Thanks for that,
So,
Pawan. I sort of really enjoyed the conversation. It's great to sort of have you on the podcast. And we look forward to
yes,
having you more and more on this podcast. I'm sure our listeners will sort of really, really gain very meaningful insights from this.